Today we are studying in this workshop the taxation of companies. And even though the previous 2 weeks have been trusts and partnerships, and they're important, you do need to know them, they're an important part of the taxation law, companies is the really important one. And so getting a handle on these rules is just essential. In particular, the rules for taxation of companies is a little bit different in Australia and New Zealand than it is from elsewhere in the world through what we call the dividend imputation system, which we've got to talk about specifically. It's arguably a superior system, but it's not widely used across the world. In fact, I'm not even too sure. Number of countries that use the dividend imputation system. Please don't just be 2. Oh no, there's a few. The UK, Ireland, Germany, Singapore, Italy, Finland, France, Norway. Oh, that's good. Okay, well, that's good. The solid countries, and Malaysia. Solid, that's good to know. What are some exceptions? Well, what are some key trading nations? The US is the main one. Okay, let's bring some slides up. Dun, 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 dun. Let's go. Second to last class too, by the way. Hooray, hooray, hooray. All right, let's go. Oh no, you don't want to see a picture of me. What we do want to talk about is companies in the general sense. And really, unfortunately, the word company, the word body corporate, and the word corporation, in some places in the tax law and other areas of law and in popular discourse, sometimes they mean the same thing and sometimes they mean something different. It's really, really flippin' annoying. But the starting point is with the word company or corporation, that when you talk about a corporation, and I guess in the technical sense, just by the way the word is structured, it is an incorporated entity. So that is an artificial entity which has legal personality. In other words, it has standing to sue and to be sued. It's a legal person in the eyes of the law. And that is something in our law is either created by legislation or by royal prerogative. And it is both in Australia and corporate bodies that are created elsewhere. That is what we talk about. When we use the word corporation, that's what we're meaning in the broad sense, or incorporated entity. Now, in the corporations law, the definition of company and the word corporation, it's called the Corporations Act. As I said, they're not perfect synonyms. They sometimes are interchangeable regards to each other. So what I'm going to do is to actually talk about the different types of corporate entities to give you guys a bit of a handle on that. It's stuff that I wish was explained to me. I'm going to spend 10 minutes explaining it to you, and I hope you'll tuck this information away because, like a lot of things, it's stuff that I wish that I was told. And it's going to give you a better handle, a better understanding on how these things fit in contemporary society. And look, the reason why corporate taxation, the taxation dividends, is such an important thing is because corporations are a core component of contemporary business. All right, Stacey, without looking at the slides, when you see the word person in a statute, what does that also include?
Law students had companies?
Yeah. So there are 2 interpretation statutes, one for Queensland, one for the Commonwealth. Both of them have a section in it that says when you see the word person, unless the word person is specifically used in the context of a natural person. So, a person must not punch another person, for example. If it's not one of those circumstances, if it just says a person that fails to submit their tax return within 28 days of the, I think it's 1 month of the end of the period in which they're supposed to submit their tax return, is liable to a penalty. In that sort of situation, it's going to mean both corporate entities and natural persons as part of that. Okay, curiously, in each of these definition statutes, they're actually written quite differently. Sometimes it'll use the word bodies corporate to describe corporate entities, and sometimes it doesn't. Okay, now, everything which is incorporated is a legal entity. So if a body is incorporated either through royal prerogative or under a statute, then it is a legal person. And from our perspective as largely accountants, you can do a set of financial reports for a corporate entity, regardless of what sort of type of corporate entity it is. You can treat that as an accounting entity. Look, accounting entities really are just a bit of fluff. You can do a set of accounts for anything. In theory, my I don't know, hamster could have a set of accounts in regards to that. However, usually when we're thinking of accounting entities, because accounting is a language of value, usually there's a connection between the ability of things to at least notionally own stuff. And as we know, can hamsters own property, Stacey?
Negative.
Negative. Sorry. What are pets treated as for the purposes of our legal system? They are
chattels and objects, property.
Ah, awesome. They are things that are owned. They do not own, they are owned. They are items of sentimental personal property. Good work. Well done. Okay, so now most corporate entities are also taxation entities. In other words, most corporate bodies do have at least the ability to get a TFN, a tax file number. Not all corporate entities are obliged to actually do a tax return, and not all entities are required to pay taxation. And note that anything which is capable of carrying on a business can have an ABN. Right, so that's corporate entities in the broad sense. Now we're going to talk about the different categories of corporate entities in the broad sense. Look, I know there's a lot of information on the slide, but it's actually really, really helpful. This is, it's more than merely a piece of legal trivia. I think this is a really helpful thing to know. Stacey, I'd be very surprised if you learned this when you studied company law. Really, really, really surprised whether you learned about these quadrants. Okay, because the first quadrant, I call these the universal entities. Okay, the second quadrant are the government entities. The third ones are the specific entities, and the fourth one are the royal entities. What do I mean by that? It's how these things are created. Okay, so the first category are these general purpose types of incorporated entities. So the one that I guess is more sort of commonplace and known to people, a company is created under the Corporations Act. What do you have to do to create a corporation under the Corporations Act? I'll pick on someone else rather than poor old Stacey. Has anybody actually done this, by the way? Have any of you guys actually gone and set up a company? I've done it a couple of times in Australia, 2 or 3 times. It's better these days. It used to be dumb. No? No one's gone to do that?
Well, register your company.
Yeah, you got to register it. So you've got to do that through a body called ASIC, the Australia Securities and Investments Commission. That is a government agency. So you do that. What are other really important things you have to do when you register a company? What are ASIC interested in?
Your TFN number.
I don't know if you can see me in the video. They are interested in you paying them some money. You got to pay a non-trivial amount of money to do that. So you look to set up a company. You have to have a constitution. You have to say who the directors are. There must be at least one. You must say who the shareholders are. There must be at least one. You don't need to get an ABN and a TFN, although you can do it at the same time. But you must get an ACN, an Australian company number, at that time. So that when you do that, you pay the fee. It's about $600 these days. There's an annual fee. You guys heard me be grumpy about it a few weeks back, of about $200 or $300. And once you've done that, by right, a company is created. A legal person comes into existence. Okay. similarly with Associations Corporation Act is very much a Queensland piece of legislation. What do you do to create an incorporated association? You need to have a committee, which must have a president, a treasurer, and a secretary. And you need to have at least 7 members. Again, you pay a fee, and it creates an incorporated entity. Okay, it's under Queensland legislation. The CATSI Act, that creates a corporate entity specific and with a slightly different governance structure. One of the reasons why these are created under different acts is they have different rules. They're governed by different rules in the various corporate acts that they're created in. But the key thing to note is that you can create a company in the Corporations Act by right when you satisfy those conditions. You can create an association under the AIA by right if you satisfy those conditions. You can create an Indigenous corporation. You can create a trade union. And what about this one here, Stacey? You know a little bit about this one, I gather. How good's your memory? What's the BCCMA? What do you have to do to create an entity under the BCCMA?
I don't know. I'll pass out on that one.
Don't know. Pass that one. All right. Anybody else? You have to have a building. A building has to have 2 or more dwellings in it. So if you build an apartment block with 20 apartments, an entity is automatically created. That entity is called the proprietors of the, and then it's got the name of the particular entity, building, or whatever the building name is. And it is an incorporated entity under Queensland law. So that creates it. And look, that's why I describe these as the universal statutes. If you meet those conditions, you create an entity. That's just how they work. So you can go as a citizen to go and create entities as you wish. You're going to pay the fees. Okay, that's the first type. Second type, where governments create it. And governments can go through and do that. Look, last time they changed the councils, which was in 2009, Stacey probably remember, Thuringowa and Townsville used to be 2 separate councils, and they merged them. They actually changed the legislation at the time, but in theory, they don't need to. In theory, the government, through delegated instruments, can create local councils. The Commonwealth can also create government agencies as well, and give those things legal personality. Okay, they can do that without having to go to Parliament in each case. Okay, the government can do those things. Now, there are also incorporated entities which are specifically created. So the JCU Act has 2 sections, 4 and 34. It actually creates 2 entities. What are those 2 entities? Well, you could probably take a stab at the first entity that is created, which is James Cook University. The JCU Act creates the university. So if you go read that act, you can look at it now if you want. Find section 4. It says JCU, James Cook University, is an entity. Concerned be sued. Has a common seal. It has a board. It has all of those things. It is a legal person. And section 34 creates another entity. It is the Student Association. So the JCU Student Association is not created under the Association Corporations Act. It's created under the JCU Act, which means it has different governance structures. Okay, other things that are created are health boards. A series of health boards are specifically created under Queensland law. Legal Profession Act, section 679, along with Shrew. Stacey, what does that create? What's the entity created under the LPA? You have done it, and you know the answer to this.
Well, I'm doing ethics now, but is it the the Law Society?
Yeah, the QLS is created under that specific statute. It's not an association. It's not under the AIA. So it has its own act. Similarly, the grammar schools, which there's 1 in Townsville. There's 8, I believe, in Queensland. They are all incorporated entities under that specific act. In that situation, it's a defined list. You can't add or subtract items on that list. It's not an open-ended class. There are 8, exactly 8. They all follow the same rules. They all have the same governance structure, but there are more than one of them that are created under that particular piece of legislation. Similarly, the Catholic bishops' governance body is created under a specific piece of legislation. Now, so that's the specific incorporated entities that are created by Parliament specifically. The final ones, interestingly, are created by Royal Charter. So that is the Queen in the case of some of these, although these days largely the Governor General does these things. They don't do this very often, but They haven't removed ones that are already there. And for, you guys may or may not be aware, one of those, if you've ever wondered why they call it chartered accountants, it's because it's under Royal Charter. So it's an entity which has been created by Her Majesty Queen Elizabeth. She said there is to be this entity. She signed it, she stamped it. It's been changed a few times, so that's like the 9th version was in the 2014. And so they do occasionally repeal the old one and create a new one, but that's what it has to be. So it has to be done through the Governor General. It's not done through ASIC. It's not done through the Department of Fair Trading. It's not done through any of the other regulatory bodies. The Boy Scout Association, that's the first one I found apparently. Theirs is still the original one from the 60s, signed by Her Majesty. Okay, so there we go. So that it's more than trivia, guys. That information in terms of where these things sit. The reason why I really want to tell you this is that the rules for governance are different for each of these types of entities. They don't have the same rules. I was horrified when I found this out when I was doing legal research, and this was after I was a practitioner, that, for example, trade unions have lower, less stringent rules for governance than what corporations do, for example. Okay. Income tax. So look, not all of those types of companies pay income tax. The QLS, the accounting society, they're not set up fundamentally to be to be entities that are there trying to make profit. And so, however, there are different types of entities that don't make profits. For example, the Law Student Society. Law Student Society is an incorporated entity. I don't know if you're aware of this. I was in charge about 10 or 12 years ago trying to get the thing incorporated. And they'd been trying for 5 years. And then I found out as part of my research that it was already incorporated and had been since the 80s. They just haven't paid the fee since the 90s. So thanks everybody for those 12 or 13 years, because they meant that we all had to pay it in one go. Go JCU Law students. Okay, and that, for example, it's not a charity and it's not a deductible gift recipient. So if you donate money to the JCU Law Student Society, you can't get a tax deduction. All right. These two things, these registered charities and deductible gift recipients, are actually not the same thing. You have to go through a process for doing either or both of those. Now, if you are a charity, you're exempt from income tax. If you are a deductible gift recipient, you are exempt from income tax by right. So if you manage to jump through the hoops, and it's quite a high bar to become one of those things, no tax. Okay. However, all of the other entities, and there are hundreds of thousands of them, literally across Australia, these other entities do what's called a self-assessment process. So if you want to determine whether your organization is exempt from income tax, you have to go through and look at these things. You have to look at whether or not the particular organization distributes profits to members, whether profits and or capital go to members, or whether they go towards a particular purpose. So for example, the JCU Law Student Society, when I did go and change the constitution about 10 years ago, one of the things that we needed to do was to ensure that if the entity is wound up, that the money and assets pass to the JCU Student Association. Okay, that was a critical thing to go through and do as part of that. You can't pass the capital and or income through to members. Okay, that's the first thing. Second thing, you've got to have a connection to Australia, either physical presence in Australia or the objects principally involve Australia. That's the second one, and it has to be one of these defined categories. So these will look a little bit familiar for those students of those law students that studied trust law, Stacey, where you've got education, the big four: education, religion, and community organizations, wherever they are, sporting organizations, things other general purpose things to the community: health, employment, development resources, and community service, but not political ones. Political and lobbying purposes, you're not going to be tax exempt for that. All right, now this piece of information for you guys, a bunch of whom are going to end up being community treasurers, and I strongly encourage you to do that. This is the good thing you can do. You will have the technical expertise to be the treasurer for incorporated entities. They will be craving not just your technical skills to create financial reports, but also your governance skills in terms of knowing how accounting and auditing controls sit and structuring those things to do risk analysis. Those are technical aspects of accounting that we learn when we do an accounting degree, and you guys are it's going to be bread and butter to you guys. When you're doing this, one important piece of information to note is that charities and deductible gift recipients can get franking credit refunds, all right, but other entities can't. All right, so just make note of that. So the Law Student Society, if it receives a franked distribution from an entity it owns shares in, it can't get a refund. All right, so just make that note. Look, I believe that there are actually systems around that, but I'm not across them. By default, you can't. Also note that just being exempt from income tax in no way, shape, or form makes you exempt from fringe benefit tax or goods and services tax. So you still can pay, be obliged to pay GST. And I think I had mentioned to you guys at some stage earlier, me being the electoral officer for the student union, one of the things they gave me was a gym membership for 12 months. And technically, I believe they would have to pay fringe benefit tax on that. I believe. I'm not sure. It's possible that as a business relationship, I'd have to actually include it as income. I'll have to check. So that's the sort of thing to make note. So the JCU, for example, has to pay FBT on a variety of things. That's why they're a little bit cagey about doing things involving events and other bits and pieces. Okay, moving on. Okay, so much like in partnerships, where the definition of partnership was widened to include a variety of other things, because the tax office doesn't like definitions being narrow. They want to catch everything. So when we use the word company for the purposes of the tax law, all right, that means any incorporated entity. So all of those types of incorporated entities on the previous ones are deemed to be companies for the purposes of income tax law. That's not to say they all pay tax, but they are all considered to be companies. All right, that's the first thing. All of the different types. James Cook University, considered to be a company. Student Association, considered to be a company. The Society of Accountants, company. JCU Law Student Society, company, and so on and so on. As well as that, it specifically includes incorporated limited partnerships. And remember how I'd mentioned this when we were doing partnerships, how saying that those are actually taxed as companies, they're not taxed as partnerships. However, this last one, oh boy, is that wide. Any other unincorporated association or bodies of persons. The JCU Business Students Society is not incorporated. Okay, it is a collection of members, and those members, in theory, all have unlimited liability for the debts of that unincorporated association. You sign on, you become a member, it's not incorporated, you're not protected. I'm not, sorry, dissing the business society, but have any of you guys on it or members? No one wants to own up to that now. I think for you guys doing it externally like Claire and stuff, around in Townsville, it's probably not a lot of point, but it's just one thing to note. The two associations they have, one's incorporated, one's not. So it means that if you sign up to be a member of an incorporated association, you will not be held liable. All you're going to can lose is your membership fee, your annual membership fee. That's it. Whereas if the business society does something naughty, you can actually be held liable as a member. So leave that one in the back of your mind. And for the purposes of tax law, it's deemed to be an entity for the purposes of going out. In other words, it's deemed to be a company. Okay, it specifically excludes partnerships, as you can imagine. That's why we spent a whole lecture going over that, and joint ventures where you haven't specifically created an entity. And I said usually if you've got a large enough situation, Rio Tinto and BHP, they might just create a company for the purposes of running a particular joint venture. Create it, put some money into it each, and then let it die afterwards. Certainly, it's a little bit dodgy. Do you guys remember a movie called The Dallas Buyers Club? Anybody heard of that film? Or any legal issues that came from it?
I've heard of it, but I haven't seen it. Sorry.
Okay. It's a pretty narrow sort of a film, very much a low-end Hollywood production. Well, I haven't seen it, but what happened was the owners and all of the big intellectual property holders, Warner Brothers, Sony, and so on like that, that owned and created all these movies in the US, they all banded together, assigned the rights to that film to a company called Dallas Buyers Club Incorporated, proprietary limited, I should say, and both all put some money into it. Okay, why did they do that? So then they could go to one of the smaller internet providers in Australia and sue them for distributing this movie in breach of their copyright. And they actually managed to get an order from the federal court giving them, I kid you not, a list of people who downloaded that film. It was including a former student of mine. He was a little bit worried, actually. And there weren't very many people, maybe 500. It was a small internet provider, so they didn't have the cash to fight against the recording studios. And it went to the federal court and then went on appeal. And they lost spectacularly, the Buyers Club people, the copyright owners. And then what did they do? They just let that company go broke. Poof, gone. Company that was limited by liability. So essentially, they'd run that as a joint venture, as a single corporate entity, and then they just let it. I lost it. They had to pay a whole bunch of money. I believe they had to pay about a money into court at a time, so the ISP didn't lose out that much. Stressful though. Okay, now if you create an entity, it's going to be a company, but if it's not, it's just a joint venture in the general law, not going to be a company for the purposes of income tax law. Okay, the legislation the entity is created and so how the entity is created, either under the general purpose, the G, my little quadrant back here, my little quadrant at the top, how the entity is created is quite irrelevant for the purposes of income tax. We don't care. A company is a company is a company. Okay. However, when we've got the lay definition of the word company, which is the word, when I say the lay definition, is the word that people think of when they think of the word company. 90% of people, when you hear the word company or corporation, they think of something with lots of money. I don't know why, but they do. It's an Australian thing. And as a result, here I've got the rules for companies that are specifically created under this general purpose Corporations Act. So the 2001 Corporations Act. So I've referred to this as the General Purpose Corporation Statute. And in regards to those sorts of companies, they have ACNs, Australian Company Numbers. They have a name, but they don't need to use the name. They can just say ACN and then the number. So sometimes you'll see cases, for example, where it just has ACN, or sometimes it'll be a full company name. If it is a private company under that piece of legislation, it must have Pty Ltd as the suffix. Private companies must have one shareholder, but can't have more than 50. So if you simply can't register a private company and have more than 50 shareholders. And remember, when those shares change hands, that is a registrable thing. You have to go and change it and update it with ASIC. Public companies, though, under the Corporations Act, they don't have the PTY. They just have the LTD at the end. So if you see that, you see a name of a company, Rogers PTY Ltd, that is a privately held company, whereas Rogers Ltd is a public company. All right, under corporations law. Now, going back to how companies work in tax law, this definition of public company is different. So here we're talking about a public company in tax law. Okay, it's nothing to do with the number of shareholders, any of those things. A different definition. For tax law, we know that all sorts of incorporated entities, included and non-unincorporated ones, and limited partnerships are all deemed to be companies for the purposes of tax law. Very, very, very broad. However, what happens curiously, not curiously, it kind of makes sense. In tax law, public companies have it easier. It's easier for them to do a whole bunch of things than it is for private companies. So they've actually got a lower bar and threshold for doing a variety of things. Whereas private companies in a variety of places actually have a higher bar. They have more compliance. Certain types of transactions are more likely to be deemed to be income or what have you in regards to that entity. So we throw away the definition of public and private company from corporations law, and we use just the tax law definition here. So anything which is listed on a stock exchange and no more than 75% of all three of these things, voting rights, dividend rights, and capital, are held by fewer than 21 people. So if 75% or more of the shares are held by fewer than 21 people, so 20 or fewer people, then it's going to be a public company for taxation purposes if those things are true. Okay, those things are conjunctive, and so you have to be both listed and no more than 75% of those things are held by few people. And the idea is that, look, you can list a company, but if it's only controlled by, it can be publicly listed, but if only 10% of the shares are owned by the public, wide, and 90% of them are owned by three entities, functionally, that's not going to be deemed to be a public one. We're going to have more scrutiny of it. That's the key reason for having this. So it's also going to be deemed a public company if it's a subsidiary. So all subsidiaries of local listed public companies. And thankfully, non-for-profit organizations, they are deemed to be public companies, mutual life insurance, registered organizations, and all statutory bodies, so councils and other bits and pieces. So a bunch of the things that were created under those specific statutes and the government statutes, they are going to be deemed to be public companies. So which, for the purposes of tax law, what is the JCU Law Student Society? Is it public or is it private?
Probably private. Yeah, they have to be private, right?
Have to be private. If Steve was here, he'd say,
Doesn't public
what does the statute say?
Doesn't public
It's a
involve
definition.
shares
It's on
in
the
that,
screen. Look at the screen. Look at the screen. It's on the screen. Remember that we ignore company law. We don't care about company law. We're looking at tax law here.
Oh, that's
Companies
what
and
I was
tax law.
thinking about.
Yeah. Yeah. So here, you notice where you've got a list of items, 1, 2, 3, and you've got an or. It's a conjunctive thing. So is deemed to be a public company if any of those three things are true. So is the JCU Law Student Society listed on the stock exchange? Well, no. Is it a subsidiary of a listed company? No. Is it a non-for-profit organization or a registered organization? It is both of those things, but it doesn't matter because it's conjunctive there as well. So it is deemed to be a public company for taxation purposes. Yes, that sounds a little silly, but that's what the statute says. Parliament is not supposed to do silly things. Parliament does everything that it intends to, and that's a rule stat interpretation. All right, so everything else is deemed to be a private company. What does that mean? For the purposes of tax law, it gets more scrutiny. That's where it is. So we'll talk about the various things that it gets more scrutiny of as we go through this this session. Oh, Well, there we go. So I've actually phrased this in the positive. This is what public companies get rather than what private companies lose. So here we go. On a variety of ways, public companies have it easier. So they don't have the excessive payment rules. They don't have to worry about the deemed distribution rules. They don't have to worry about, well, they do have to worry about the continuity of ownership tests for the purposes of tax losses being carried forward. All right, franking credits, but it's much less stringent than private companies, and they get 2 franking periods, which I'll explain what that means. Just gibberish at this stage instead of 1. It's a minor benefit, which I'll talk about a little bit later. Okay, tax rates. What's the tax rate? For most entities in Australia, for most entities, it's going to be 25%. Now look, technically it was 26 last year. It's going to be 25 this year. For the purposes of this subject, I'm just going to say it's 25%. It's so much easier. We don't have to muck around. But note, if you have 80% or more of your company has passive income, it's going to pay the higher rate if it's 80% or more, or if it's if its turnover is more than 50 million, then it's going to have the 30% tax rate. So I phrased this in the negative, positive. I phrased that in the positive, but things actually technically phrased in the negative. So just make note of that. If you think about it, the government wants to tax larger corporations, and it wants to tax corporations that are just holding entities that aren't doing anything. That's why they have a 30% tax rate, whereas other ones have a 25%. Okay. So, taxable income. All right, this is fun. When I say fun, Stacey's not going to find it fun, but the accounting students might find it a bit fun because you get to use all your accounting knowledge. Right. So, as anybody that's studied accounting for more than a year will know, you are creating financial accounts, as a non-zero fraction of your of the outputs that you have in accounting as a discipline. And don't get me wrong, there are other sort of things. You have actuaries and you have auditors and other bits and pieces, but when you're doing your degree, you're going to have to create financial reports from time to time. One of the things that you'll do when you go beyond sort of a high school level of doing accounting is taking an accounting for taxation. And when you are doing that, almost never is the amount of net profit for a particular financial year the exact same amount as your taxable income for tax purposes. Almost never. And there is a specific accounting standard, so it's ASB 112, which says you need to do a reconciliation. You actually need to demonstrate why net profit and taxable income aren't the same thing. That's what a reconciliation statement, a tax reconciliation statement is. So to do this statement, you will, this might end up being an exam question, I think. I've got to write the exam soon. Maybe. Yeah, it seems like a pretty straightforward thing to do. So to do this, you need to calculate net profit. That's the first thing. So you got to put your accounting hat on. What is net profit? It is, what's the definition? What are the 2 things you need to know to calculate net profit? This one is not for Stacey. This one's for literally everyone else. When we're doing accounting, what are the 2 pieces of information we need to calculate?
I was going to say, I hope no one's leaving this one for me because...
No, they better not, because this is for the accounting students out there. What are the 2 pieces of information you need in your profit and loss statement, or what it's called? They changed the name about 20 years ago while I was studying accounting to call it a statement of financial performance. I think it's stupid, but everyone at the time said this is stupid, and then after a while they're like, oh, we're just going to go back to the old one. Profit and loss statement. What are the 2 things you need to know to calculate net profit? Come on, guys. And you can find it on the slide. Yeah, it's revenue and expenses, usually we call them. And I've got them on the slide there because that's the language the standard boards people use. So you need to know your revenue and you need to know your expenses. That's it. That's the starting point to calculate net profit for a particular financial year. Okay, and you do that using your accounting principles. Then you've got to do 4 steps to work out your taxable income. And look, it seems pretty logical. You've got to take things that are assessed for tax purposes, but are not revenue items. Okay, one example I've got here, and I took some of these from the book, but I've added some more myself. One of those are the gross up values. As you're aware, if you buy shares from Telstra and you receive $700 cash, how much is added to your taxable income? What's the amount? It's added. If you get a fully franked distribution of $700 cash, how much is added to your revenue? And we'll talk about it today, but I can tell you for now, it's going to be this, because you will have attached to a fully franked distribution $300 worth of franking credit. So what does that mean? Well, for the purposes of accounting, it's $700. That's the amount that you receive. That's the amount of net benefit the entity gets. Franking credits are nice and all, and we can use those to pass value to shareholders, so to speak, but they are not part of the revenue and expenses component of calculating your net profit. Okay, so those, we call it the grossed up values. So it shouldn't be grossed up value, it should be the franking credits. Oh, damn it. Sorry, I meant to change that. Really grumpy because that came from the textbook and it's just wrong. So the amount that we're adding is not the grossed up value, it's the franking credit. God, it just makes me cross. I'll change that. It should be franking credit, FC. So that's things that you have to add in as part of that. All right, next thing you have to add are where you've got expense items, so when you've included it in your net profit figure as an expense, but it's not tax deductible. So that is things like entertaining clients. So if you've got entertainment expenses or paying fines, for example, those are things which are not tax deductible for policy reasons. It's in the Act. You get a fine, you can't deduct it. However, it still is an expense for the purposes of accounting. You're determining net profit. Okay. The other thing, by the way, is also where you've got your book value, so your book amount of calculated depreciation using accounting standards. If that is higher than the statutory deductions, then that will have to be added back. Then next step you do is take away items that are included as revenue, but aren't accessible. And so the one that I could find was government grants. So if you've got an amount like a COVID government grant, it is non-accessible, non-exempt income, all right? That still, for the purposes of net profit, has gone into your books for calculating net profit. You've still gained from something in the period, but it is not accessible, so it doesn't form part of your taxable income. You've also got to take away amounts that aren't expenses, but are tax deductions. You can see these things here. These are in reverse, by the way, obviously. Subtract items that aren't, something like that. And that's where if for whatever reason you actually are able to get a bigger tax deductions than you are able to include in your books, so to speak. That one doesn't come up as much. All right, so that's the first bit. That's the first step. That is to reconcile net profit with taxable income. The other component of the tax reconciliation statement is to then show how much tax you're going to pay. So you need to do these 3 steps. You first of all do the multiplication. So determine your rate, 25 or 30. Take away any installment amounts you've had during the year. Take away your any foreign income tax offsets, and take away any franking credits that that you may have earned in that period. Okay, oh, Maddie's back. Okay, and that will tell you the amount of tax which is payable in your in a particular period. Okay, FITOs, so foreign income tax offsets. You do need to know this just a little bit. We do this much, much more in advanced tax. Most governments are pretty cluey in knowing that when they pay money to non-residents, remember how like non-residents are still supposed to pay Australian tax, for example, on their Australian source income. We know this. If I'm a New Zealander and I live in New Zealand but I own Telstra shares, and they pay a distribution to me as a non-resident, I have to pay tax on that. Non-residents pay tax on their Australian sourced income. However, what are the odds the Australian government's going to get that tax out of me if Telstra just paid me $1,000 straight? What are the odds that I would voluntarily call up the Australian tax office and pay that money? Pretty close to nil. And as such, all countries recognise that this is the case, and all countries, when paying distributions, will when they have resident companies that pay distributions, insist on those distributions that are going to non-residents to have tax withhold. We call that withholding tax as part of it. Like technically, it's more a provision than a tax, but leaving that aside, all countries do this. So if you get amounts that are distributed from overseas, say for example, we get UK shares or New Zealand shares. Say it's not called Telecom New Zealand; it's called Spark New Zealand. Stupid name. Is that a better? Oh, maybe there's a better. What's a better one? Kiwi Bank. There we go. Can't go wrong there. So if you happen to have shares in Kiwi Bank, and which I don't think you can buy it, I think it's listed. Oh, that's a stupid example. Air New Zealand. If you have shares in Air New Zealand and they pay dividends to you as an Australian resident, money is going to be withheld by the New Zealand's Inland Revenue Department and paid to them instead. So, and look, the amount that's withheld varies. Again, we do that in advanced tax. The key thing to note, though, is that if you get distributions from overseas corporations where money is withheld in that overseas jurisdiction, you actually get a tax offset in Australia. It's called this FITO, foreign income tax offset. However, you might not get the amount which is withheld. The amount of it you get is the lower of the amount of tax withheld and the amount of tax that would have been payable in Australia. And that can be something of a problem for companies in Australia which have the 25% tax rate, which is most. It's the base rate entities. Why? Well, if you, again, have New Zealand shares and they clip 30%, so again, it's the same thing here. You've bought shares in Air New Zealand, they've given you a distribution of $1,000, of which 700 is cash, and 300 of which is what we in New Zealand call imputation credits. Here they're called franking credits. You're not going to get $300 of benefit from that. How much will you get? So if you've got from Air New Zealand, ANZ, that's a bad example, I'll put Air NZ, they've given you a distribution, just pretend it's in Australian dollars, of 700 cash, and there's $300 of imputation credit, so withholding tax, whatever you call it, that's been withheld, and that's been sent off to the New Zealand government, to the IID it's called over there. All right, based on this rule here, if you're an Australian resident company, it's actually the same for individuals anyway, but if you are an Australian resident company, how much of that $300 are you going to be able to claim as a tax offset here? Assuming that you're a base rate entity. Because you're going to have to include $1,000 worth of income. Right, so your income's going to go up by $1,000. $300 has been withheld. However, the amount you can claim is the lesser of the amount of foreign tax paid, which is $300, or the amount of tax that would have been paid in Australia. What's the amount that would have been payable if you earned $1,000 in Australia and you're a base rate entity? What's the tax rate for base rate entities? This is one of those moments where, oh, Stacey, you never had Rachel Bradshaw, I don't think, as a lecturer, but Rachel used to say, after silence, and then they go, okay, Simon, you can just talk. I was that yappy mature age student. What's the tax rate? You can put it in the chat. You don't even have to do your microphone. Tax rate is 25. It's 25. It was in the, sorry, Maddie, it was on the previous slide. It's 25. Yeah, it's just, assume here that it's 25 for base rate entities. So most companies. How much tax do they pay? You would pay $250. So would you be able to claim all $300 that's withheld? No, the foreign income tax offset's only going to be $250. So that is the amount of the foreign income tax offset. Is that bad for you? Yes. It means you do have to pay more tax. That is how that works. You probably need to know that rule, because that, given how long and how hard that was to get that out of the class just now, that one's gone in the exam. Yeah. All right, moving on. Losses. All right, company losses. We did talk about losses when a little bit. When we talk about income, and I've talked about with partnerships, and we didn't talk about them at all with trust. Well, not much with trust, because trust can't distribute them. Partnerships can, but trust can't. Companies don't distribute losses; they carry them on. However, it would be really easy of the 7 of us to put in $100 each into a company and then lose $1 million. It's real easy to lose money, as we've all of us have been on this planet collectively for many years. We know that it's real easy to lose money. It would be outrageously easy for the 7 of us to put in $100 each, lose $1 million, and then on sell our shares in that company. Remember, we own them as individuals. On sell them to, I don't know, BHP. So they would get $1 million worth of tax loss. And which would mean they would pay $300,000 less tax. It'd be really easy to do, trivially easy to go through and do. They'd probably pay you, $270,000 for that. Now, as a result, for quite a long time, as an anti-avoidance mechanism, you have to demonstrate that there is a connection between the company with losses, the company when it makes the losses and the people who own it, and the company at the time those losses are applied, because they're 2 different periods in time. And to do this, in order to actually be able to apply the losses in a particular year, you have to demonstrate one of these 2 tests. And to be honest, it's a 2-step test. You don't bother looking at similar business if you can satisfy continuity of ownership. So continuity of ownership is basically for private companies. Oh, sorry. No. That's a different definition. For companies that aren't widely held, from the period when the loss was made to the period where the loss is applied, and again, you can have multiple years where this happens, you have to demonstrate these things here. Okay? You have to demonstrate that the same persons, both directly or indirectly, have controlled more than half of voting power, rights to dividends, and rights to capital for all of those periods. You have to demonstrate that. Okay, the same persons must have controlled half of that company or more for each period in between. Okay, that is the continuity of ownership test. All right, that's the default rule. However, If you are a widely held company, then you don't need to demonstrate this throughout the whole process. You only need to demonstrate that the bid at the end, when you want to apply it, is the same as what it was when the loss was made. And for the purposes of these of small shareholders, so direct holdings of less than 10%, for those purposes, they are treated as if they were from one fictional notional entity. Here, we're concerned whether it's the same person, have either controlled directly or indirectly. So that if you have a company which has got lots of small shareholders, okay, where no person owns more than, say, 9% of that company, all of those 9% added together are going to be, the whole company. It's going to be more than 50% anyway. All right. And another way you can go through and do this is that where you've got a holdings between 10 and 50% are held by another widely held company, they are deemed to be held directly just by that entity. So you don't have to do a test of control, because ultimately you've got to demonstrate that control is either directly or indirectly done by more than half of the persons with those rights. So that for widely held companies, they make it a tad easier in a variety of ways. What's a widely held company? Well, it has its own definition. Again, it's in the definition section of the New Tax Act. Either listed companies or a company that has more than 50 members and at least 20 people hold at least 75% of the voting rights. Okay, so you've got to have 21 or more people hold 75% or more of the voting rights in that company. Okay, that is the continuity of ownership test. If you satisfy that, tick the box, done, which means you will be able to apply the losses that you had here at this stage here. Okay, I know there's a lot of rules, it's a lot of information to go through in regards to this area of law, and ultimately it just is, it's a complex thing. There's lots of little rules. Okay, next thing to look at. All right, similar business test. This is a factor-based test. So you only do this if you can't satisfy the change of ownership test. Oh, there's another typo. Oh, far out. So annoyed with myself. Company. All right, so you can still obtain a deduction. In other words, be able to claim this deduction for a in the current year or the year that you want to apply it from a previous year, if you can demonstrate a continuity of business. Okay, so when doing that, they're just going to look at what you actually do. You have to have this element of continuity. So it's a factor-based test. If you have to maintain the same identity and the same primary source of income. So they're going to look at the assets and how those are used to generate income. They're going to look at the activities and look at whether or not these activities were the same as the period in time when the loss was made. They look at the identity of the business and identity of the former business. So look at what they were at those two periods of time. And they look at changes. Okay, and again, changes in assets, products, processes, services, or marketing, organizational methods. It's a factor-based test that the courts will ultimately go through to do. And look, with these sorts of tests, if you're in doubt, you can seek a private ruling from the tax office in regards to that. The ATO is bound by private rulings, provided what you've done is true and correct. Okay, that's the similar business test. As you could imagine, the continuity of ownership test is better because it's mathematical. All right, you don't need to do a variety of things. You just need to look at who the persons are and what fraction that they've controlled, directly or indirectly. Okay, that's a mathematical test. The similar business test is a factor-based test. It's a question of scale and degree. All right. I'll talk about R&D just briefly, then we'll have something of a break. Okay. Right, and R&D. This is its own little mini topic. It's only 2 slides on it. Basically, as an incentive to encourage organizations to spend money on R&D activities, you get some tax benefits. All right, the activities have to be things that are carried on in a scientific manner for the purposes of generating new knowledge. All right, you have to have that. Or it can be an activity which supports that definition. Okay, things that support those particular activities. And you can become registered to become an R&D entity, right? So that you have to actually ask the Department of Industry, Innovation and Science to be deemed an R&D entity. It's actually not the ATO. So you can, once you've done that, then get the benefits of these things, which is where you have spent direct or had direct expenditure on R&D activities or depreciation on assets used in R&D activities. What you do is, if you have those things and you would normally get a deduction, you don't get a deduction. I know it sounds a little bit silly, but you don't get a deduction. All right, so that's the first thing you do. So say you've spent 100 grand on those activities. All right, you no longer get a tax deduction, $100,000. What you instead get is an offset, a tax offset. Remember, tax offsets go towards tax payable, and they can be situations. These can be carried forward as well. I should have said applies an offset. It's a carried forward, not refundable, I don't believe, but I believe it can be carried forward. But the amount is 43.5%. So how much benefit would you get, assuming that you're a base rate entity? So if you've spent $100,000 on R&D activities, what's the tax benefit you get spending on R&D activities as opposed to non-R&D activities if you're a base rate entity? How would we calculate that? Well, the amount of tax offset you're going to get on $100,000 is going to be $43,500. Why? Because it's 0.43 multiplied by 100. So that's the amount of tax offset you're going to get. Now, we know that we're not allowed to claim a tax deduction on these things. So if we had spent $100,000 on stuff that was ordinarily deductible, instead of that amount of tax benefit, we would get, as a base rate entity, $25,000 worth of tax benefit, so to speak, because that would be the amount of tax that we would be paying, that we wouldn't have to pay through incurring another $100,000 worth of expenditure. So the difference between those two things, $18,500. That is the amount of tax benefit that you get if you're a base rate entity. If you are paying 25% tax. Now, that's if your turnover is less than 20 mil and you're a base rate entity. So they get the biggest, percentage-wise, tax benefit. If your turnover is more than 20 mil, this offset amount is only 38.5%. So you still get some benefit, but not as much. Okay, you can't get this offset if you're spending less than $20,000, and you can't get the offset if you're spending more than $150 million. You still get a tax deduction, but you're not going to get an offset for every dollar and beyond that. It's been something of a theme when we've looked at particular words and phrases in tax law and how takes the ordinary word or the ordinary definition of this and expands it because they want to try and cover the field and catch it. And so dividends include any sort of distribution. So you don't think of dividends as just being cash, although for the purposes of the examples we're going to use here, if you have a company and you give whatever to shareholders, you give them stock, trading stock, for example, or give them some form of benefit, then that is going to be deemed to be a distribution. And so here, look, there's a couple of concepts we've got to start with, though. That while the deeming rules will say that anything, I said, you give trading stock to shareholders, that's going to be a deemed distribution or deemed dividend. For the purposes of what we're doing here, though, we'll just consider them to be cash distributions. A couple of things to note, though. Distributions or dividends have to be made out of net profits. Sorry, they are usually made out of net profits. Usually you're not distributing things other than profits and accumulated profits in regards to dividends, because if you weren't, you'd be distributing capital, which is, again, can be fine. Companies are allowed to go through and do that as long as we're sort of clear on that. So for the purposes of dividends as an income phenomenon, then that is an amount which is paid to shareholders. One thing I haven't noted in there is that paying dividends to shareholders is not a tax deduction to the company. I actually cannot believe that I didn't put that in there. I mean, it's funny when I say that out loud. It should be so obvious it goes without saying, but I probably should have noted that as part of it. Now, however, the people that receive those dividends receive that as assessable income, so that when you are going and receiving dividends, you have to include them as income, and you include in it the amount of cash that you got paid, as well as the grossed up value. Okay, if it's a local company, franking credit, otherwise the amount of tax withheld. All right. Now, we have a system called the imputation system, and earlier in this recording we looked through, there are a bunch of other countries have it, but they're very much the minority. There's only, I think we worked out, there were like 20 or so, and it is the logical system. So other countries that don't have this are doing it, as far as we're concerned, are doing it wrong. So basically, if you were to own one company, let's say you own this company here, we'll call it, oh, where's my little cursor gone? All right, we'll call this C1. All right, and here's Stacy. There you go, there's Stacy. Stacy owns company C1. All right, company C1 owns some shares in company C2. Company C2 owns shares in some company C3. As you could do, quite reasonably, you could have a company, it could own other companies, and then that owns some shares in C4. So, if we didn't have an imputation system, which is what, for example, they have in the US, and C4 pays a dividend to C3 of, say, we'll say it was $85,000, all right, and 15% tax. Just say they have a withholding rate of 15%. What happens? Well, $15,000 goes off to the American, what do they call it? What's their revenue called? IRS. And the rest goes here. Now, assuming that was the only bit of revenue that this company then has, it's got 85,000 cash, it then tries to pay that to C2, and 15% is clipped again of that amount. 15% admittedly of a smaller amount, of only 85. And then C2 would then pay an amount, and that would be clipped at 15. All right, and then when C1 pays distributions back to Stacy, that would be clipped at 15 as well. What's the effective rate on that? It's 15 plus 85% of 15 plus 85% 85% of 85% of 15 plus. So the net result is, with this particular example, you're probably looking at around 50, about 50 approximately percent. You get mathematical types. The effective rate that you'd be paying would be 50% tax. We think that that's dumb. We think in a situation like this that the first company should just pay a decent amount of tax and then pass those credits on to its shareholders. And if that happens to be another company, then those credits can be passed on to its own shareholders. So rather than having this silly way, like they do in the US, we instead would say, look, you're going to be paying more tax. You're going to be paying, say, 30% tax, right? Then when you pass this distribution here, rather than passing through 85,000 and just clipping it 15,000 setting off the IRS, what you've already paid tax. C4's already paid tax. So when it passes this amount on, it's going to only pass on 75,000, all right, plus 30,000, all right, as a franking credit. So this 30,000 that's passed on, it's passed on in the form of a tax credit. And so when C3 passes it on, it is doing the exact same thing. Why? Because it's included $100,000 worth of revenue. It's just paying it on because this credit got paper clipped. Think of it as a paper clip. Oh, it's a terrible paper clip. Try again. Better. Got paper clipped to the cash distribution. That is why where franking credits work. And so when this one goes down here, it's going to be 75K again, plus 30K as a franking credit. When it gets into Stacey's hands, she gets $75,000. All right, as opposed to approximately $50,000. And she includes in her income 100,000, but gets a tax credit of 30,000. So if Stacey's on the bottom marginal tax rate, $100,000 is a pretty good return. It's perhaps not. I should have probably dropped a digit off that and made it $10,000. If it was everything was just divide everything by 10 in this example. But if Stacey is, if this is the only income she has, then she actually gets to refund those amounts to those franking credits are refundable. If she's on the top marginal rate, so which is 47 cents to the dollar, she can have to pay some extra tax. Because ultimately, she earned $100,000. So the point of our system is to pass income so that ultimately you don't have silly situations where you're clipping the thing as you go. The ultimate person, here I'm thinking natural person, who's getting the benefit of the income at the end pays tax on their marginal rate. And their marginal rate, if they're wealthy, is 47 cents to the dollar. So we're not losing out from a distributive justice perspective. Any person who thinks the American system is fairer to the poor, or what do you call it, the common person, is just dumb. That's it. I got no other way of saying it. It's just dumb. Our system is both more elegant, more logical, and ultimately fairer. It was said that, and there was about 10 other countries that have a similar sort of system. The Americans do not. So, does this make sense to you guys? Because this, really getting your head around this, is ultimately that you're going to need to do this before we can move on. First thing we've got to get our head around is the language. Now, think of yourselves as owning companies, which, to be honest, all you guys should have companies. You should all have your own closely held company. Which one that drives me nuts in Australia? Why is it so expensive? Why so expensive? But ultimately, you probably should reach a point where set up your own business, do it in the company structure. It's a piece of property, you own it, you grow it, it's your thing. Now, one of the things about having closely held companies that you know, knowing and how and where these rules work, you can use these to your advantage. Now, unfortunately, the language is a little obtuse because when you have a company, say you've got your little closely held company that's paying you distributions, you might want to pay yourself straight out of just cash without having any credits associated with it, or you might want to pass on company tax which has been paid in the form of dividends and distributions. Either of those things aren't problematic. At different times, you may want to do it in different ways. That's fine. Now, when large entities are paying out their shareholders, where you've got 100,000 different shareholders and you're paying these things out, they have to work out, and they do this either once a year or twice a year, what amount of credit they're going to attach to a particular distribution. A fully franked is one where the maximum amount of franking credit is applied to a particular distribution. In the case of companies that have the top tax rate, a fully franked distribution is going to be a situation, I think I used this example earlier, where you have $700 cash plus $300 worth of franking credits for a $1,000 distribution. Okay, so to determine what the maximum amount of franking credit is in regards to for a company which has a tax rate of 30, you just divide that by 7 and multiply it by 3. Divide by 7, multiply by 3, or really just multiply it by 3 over 7. That's how you determine the maximum amount of franking you can get. And that is where you have what's called a franking percentage of 100. It's 100%. So down here, where I've said the amount of franking credits attached to a dividend is equal to the amount received, so that here, $700 cash, times the relevant company tax rate, so 0.3, I think it is, and for a large entity, and 0.25 for another one, divided by 1 minus the relevant rate. So the amount of frank credit we've got here, the amount of cash that's paid, you multiply it by, technically, you're multiplying it by 0.3 divided by 1 minus 0.3. And then multiplying it by the franking percentage. So a fully franked distribution has a franking percentage of 100. What that means is that all of the credits that could possibly be attached to this distribution have been. So you've been given an amount in cash, and there's a franking credit associated with it. If it's a 100% franking percentage, and it was a large entity with turnover of more than $50 million that's paid it, for every $700 or $7, you're going to get $3 worth of franking credit paper clipped to it. That is how franking credits ultimately work in regards to distributions. Okay, really important point. When you get franking credits, so you are the recipient of franking credits, that is added to the cash payment for the purposes of your taxable income. So when you get a $700 fully franked distribution from a large entity, you must take the $300 franking credit, add that together with the cash amount, and as a result, your TI is going to increase by $1,000. If you just remember that particular equation or that particular, everything's as easy and it flows back from that. Okay, now you may or may not recall the 2019 election. Who here got to vote in the 2019 election? I think it might have been my first federal election. Maybe, I can't remember. 2019, 26, maybe the second one. So apologies to those that you've got to be on the electoral roll, an Australian citizen, in order to vote, or a couple of exceptions. Kiwis can't vote. They live here, pay tax here, they don't vote. Strange. I went to Ian McDonald, by the way, just a piece of trivia. Went to Ian McDonald, who was our local senator, who was the committee, the chair committee of the Kiwis Living in Australia committee, or whatever it's called. He had no idea. No idea. It was embarrassing. And that was the year before kids who were born here with New Zealand parents were about to go to university, or rather they weren't, because they weren't eligible for HECS, which is just going to create an underclass of people that didn't really notice, because you don't really notice Kiwis living in Australia. There's a lot of them. Seriously, it's 4% of your population, so it's a million, between 1 and 1.5 million. I mean, that's that's the population of everything and everyone in Queensland, less the greater Brisbane area. There's that amount of New Zealanders in this country. We're everywhere. Anyway, 2019, the Labor policy, for whatever reason, got picked up by Rupert Murdoch because it was sold to the public like they were taking franking credits away from retirees, and it was utter nonsense. Just the whole thing was just stupid. If you ask, I'd say 97% of the population how franking credits work, I think you'd not get the sort of, we'll go with granularity that you guys are going to know once you've gone through and got this into your heads. Because yes, franking credits can be refunded. Yes, they are. The bar for individuals who receive franking credits is pretty low. Yes, we do accept that. But ultimately, it's only a small fraction of people who are obtaining franking credits but don't have much taxable income. Because the idea is that if you're on a low, you're on a low tax bracket, yes, you can get a refund on your franking credits. Who is this applying to? I don't, anyway, lay that by the by. Just make notes, only individuals who are qualified persons, which is a bit strange because I don't quite know why that was said there. And then again, later on, it talks about natural persons, but anyway, by the by. Companies can't do that. They convert excess franking credits into tax losses. And again, there's a calculation for doing that, which we'll get to. So what's a qualified person? Look, it's a very low bar. If you've held your shares 45 days for their ordinary shares or 90 days for preference shares, or you've asked the ATO nicely and had what's called a franking credit ceiling applied, or you're a natural person, which again seems a bit strange because what else? Look, to be honest, I think it means partners and partnership and trustees don't get this rule. But if natural person, so just Madison, for example, if you have less than $5,000 worth of franking credits for the tax year, or you're receiving the dividend as part of winding up, in which case you're a qualified person and you can refund those franking credits. Again, after you've paid your tax, usually you apply them towards tax which is payable first. You can't just ask for them the day after you get paid a distribution. You've got to wait until your next tax return. That's qualified persons. Now, for companies, they have to do an extra step. So if you've got a franking credit, again, we'll go back to our little example, our 10,000. So we've got, $7,000 cash distribution, and we've got $3,000 worth of franking credit. Oop, there's our little credit, which is paper clipped to the distribution. Oh, do my little paper clip. Better. All right. You have to include in this case, $10,000 worth of income. Sure. However, and you may recall when we talked about tax losses that Parliament doesn't like tax losses. And so they make you take your exempt income and apply those first. So when you have excess franking credits, in that year that you have this excess franking credits, you have to actually go take the amount of exempt income that you've earned in the year. So say you got a company, you earned a $5,000 government grant or a scholarship that was going to be passed through to your employees, for example. If you had $5,000 worth of exempt income, you'd have to multiply that by your tax rate. So say you're a small company, so we'll go 0.25. And that would be, I probably should use a better example, but say if that was the case, you would have to reduce your franking credits that you were otherwise going to apply by that amount if you have exempt income. That's the first thing you're going to do. So in this particular example, this would reduce our franking credit down to $1,750, for example. Now, once you've done that, you then need to take the amount of franking credit, 175, I should have used better numbers. You've got to divide it by your tax rate. So if you're at 0.25, that's going to be the amount of tax loss that you're carrying forward. Now, in this particular case, dividing by 0.25 is the same as doing what? It's the same as multiplying by 4. So we double that, 3.5. So actually think kind of confusingly. Actually, I should have used better numbers. In this particular case, the amount of tax loss that would be carried forward would be 7,000, which is 1,750 divided by 0.25. That's just an example of having just this distribution of those amounts and this amount of exempt income in that particular year, just by coincidence. That the numbers are the same as 7, but ignore that. That's just coincidence. Okay. Clear as mud? Why do you do this? That's a very good question. This is a relatively new rule, which wasn't how we had dealt with franking credits when I studied tax law about 10 years ago. Okay, next thing we're going to look at. So we don't want people, particularly in private, small, closely held companies, to be able to sneakily get money out of their company. And so we have this Division 7A, or 7 capital A of the old Act, which are the deeming rules. They're pretty strong. And they apply to private companies. And again, this is private companies within the meaning of the tax law. So these are ITAA, Income Tax Assessment Act companies, not private companies within the meaning of corporations law. So, look, there are also other situations which will apply to any company, which are up here. Yeah, they're a little bit more obscure in regards to whether those things are in terms of issuing shares and buying them back and other bits and pieces. All right. So the key one that we're interested in are the Division 7A deeming rules. Okay, so the starting point is where you've got a private company that is making a loan or a payment to a shareholder or associates of their shareholders. All right, by default, automatically deemed to be a dividend. So you give money, you're a company, give money to your shareholders, deemed to be a dividend, all right, by default. Okay, that's the first. So it's a loan or a payment, and where you've got a debt owing to shareholders or associates, which is forgiven, that's also automatically going to be deemed a dividend or distribution. All right, so if you fall under these deeming rules, you have until the end of the tax year to pay it back. And if you don't, it is included in you, the shareholder's income, as income, 100% income, an unfranked distribution. So if, let's say, Stacey, you've got your privately held company. If you take or try to make an argue that a certain payment is made to you, or that you the company forgives any debts that it owes you in those situations, or it does a loan, even it says, look, I'm just going to lend you this money, it's by default it's going to be deemed to be a distribution, and you as the person who received that cash have to include, either repay it or include it in your income as an unfranked distribution. So the amount of money that you received is going to be a dividend, and you're going to pay tax on that. That's how that works. So that's the default rules. All right. Are there exceptions to this? Yes, there certainly are. Okay, so we sort of categorize these into loans, payments, and debt forgiveness. So the first one of these are loans. Sometimes you can loan money to your shareholders, and that's fine, sometimes. So again, going back to Stacey with her closely held company, so say you're the only director and the only shareholder, by default, if your company gives you money, it's going to be deemed a distribution. However, you can, if there was a genuine debt that was owed. All right, so if the company genuinely owed you an amount of money, making that payment's fine, tick. If the amount or payment was a loan to another company, that's going to be fine as well. If the payment is going to be accessible in Stacey's hands anyway, so in other words, it's deemed to be income under some other mechanism somewhere, that's fine. We don't care. We don't care. All of those are fine. Now, so those are payments. All right. So if you're making a payment, those things there, payments or loans to other companies, or if it's going to be accessible to Stacey anyway, we don't care. That's fine. Now, if Stacey's business is a lending business, all right, and so loans are made in the ordinary course of business and on commercial terms, that's going to be fine too. Those loans are going to be fine. If you've got specific loans that meet certain criteria, and I've got this criteria-based loans we've got in a separate slide which we'll talk about. Also, if you're purchasing shares, so if Stacey is both a shareholder and an employee, and there's an employee share scheme registered, has to be registered with the tax office, that's going to be fine to loan money in that situation. And in a situation, you can ask the ATO if deeming this to be income is going to cause undue hardship. So usually things like that are not so much the amount of money that's loaned or lent, usually in a situation where it's going to push people over income thresholds, because this country is obsessed by income. And so as a result, there's a variety of other mechanisms that where government agencies key things to. So HECS, for example, is one. Child services is another, where you earn beyond a certain amount and then you have to pay more money to your ex-partner or the other parent. There's also a variety of other government things where you lose when you go over certain thresholds. You had $150,000, you can no longer be in the solar rebates, or you can't get a first home buyer's loan. And just there's a variety of things where this comes up. You'd have to argue the specific points to the tax office in that situation. Now, when we are looking, we'll come back to the criteria loans. That's the next slide. There is a limit when payments or loans are made to shareholders, and this comes from accounting. So there's this idea that dividends can only be paid out of profits. If you've already distributed all of the profits, then it's no longer a dividend that's being paid. It's capital. It's a capital transaction. You've paid all of the profits that have been made out. You don't have this anymore. So this idea of this distributable surplus is basically using accounting principles, so AAB book values for assets and liabilities, where you work out net assets, all right, and then you remove a bunch of the potentially dodgy transaction, all of the deemed transactions, and you remove the paid up share capital. So you've got these dodgy transactions, the deemed ones, including repayments of these non-commercial loans and deemed loans. But basically, you guys, what's this? What's A equals L plus E? What's that more commonly known as? Sometimes it's a P instead of an E. What's that formula known as? Sometimes it's OE. Sometimes it's P for proprietorship.
Asset equals liabilities plus equity.
Yeah, and that is the accounting equation. And the accounting equation, even though it's going to be obvious when I say it, but you may not have thought of it, because I didn't think of it until I went to a university lecture. It is a tautology. What's a tautology? There we go. But you guys are learning all sorts of things today. I'm super, super proud of you. What's a tautology? No idea? Oh, really? You've never heard that phrase before? Okay. A tautology? Tautology is tautology, let's spell it right, equals a statement which is true by definition. Right? It's not true because of any facts in the world. It's true because it's something that we defined ourselves. Now, the single most important phenomenon, well, it's not a phenomenon, it actually isn't a phenomenon, but is a tautology, is this. All right, or possibly even easier. 1 plus 1. Okay, mathematics. Mathematics is true by definition. The number 2 is defined as being 1 plus 1. Okay, this is not something that comes from experience. It sits outside of experience. It is known, or it's the very famous German philosopher that Stacey might remember from that legal ethics. I'm doing legal ethics now. Well, last year I took the first lecture of legal ethics. A guy called Immanuel Kant, K-A-N-T, one of the most intelligent people to ever live, and made the comment that mathematics exists outside of experience. It is a priori. And the accounting equation is a tautology. It exists. It doesn't exist anywhere in the world. It exists because assets, we define the assets of an entity as equal to the liabilities plus things. Everything something owns is equal to everything it owes, even if it's to itself or what have you. That is true by definition. So the accounting equation can never be wrong because it's a tautology. Okay, does that make sense? Because it's just from a piece of philosophy and logic, it's a really helpful piece of knowledge to know, particularly when you get into arguments with stupid people, which, again, try to avoid doing that, who try to argue tautologies. You can't argue tautology. Well, you can, but it doesn't make any sense. I'm not going to have an argument as to whether or not 7 is equal to 3 plus 4 because we've defined those words that way. It's not an argument. It's true by definition. What's the opposite of it, by the way? Anybody know what the opposite? Oh, if you don't know what tautology is, you probably don't know the opposite. The opposite is called an oxymoron. That is something which is false by definition. Again, not through anything to do with the world, just the way the things are defined. Okay. Right. Just make note when you're going through and doing this process where you're determining what the deemed dividend limit is. In other words, the amount of money that the company could possibly distribute can only distribute out of its profits, leaving aside all of the dodgy deemed transactions. The ATO will look at your ASB values, make sure you're doing that properly. So you guys are going to be accountants, most of you, and you've got the accounting principles and standards that you've got to live by. So if you're doing this professionally, you're probably not going to undervalue things, but if there are dodgy people everywhere, the ATO can, if they deem this to be a significant undervalue in regards to, or overvalue of assets, liabilities, in order to do this. Now, I've stopped to have a think about that because, yeah, in terms of the deeming rules, in terms of when you're trying to look at what the particular surplus is, yeah, you can have a situation where these things, because they're not valued in tax law, they're being valued using the accounting rules from the Australian accounting standards. And so the tax office can jump in and make a determination in regards to those. But ultimately, it's what you guys as accountants are going to determine for working out what a distributable surplus is. Now, the next thing, what we call those criteria baselines. So go back to Stacey with her company. You can lend money to shareholders, all right? Even if you're not in the business of ordinarily lending money, you can do it. However, you must meet these 4 criteria. So there's a little and in there somewhere. There it is. There's my little and. All right. And the 4 criteria are, first of all, it's got to be in writing. Secondly, it's got to be near the, it must be at least the benchmark rate, which is currently 4.61 or something. It was going to go up quite a lot, and then the budget came, and then they just scrapped that. This government's the worst. They're just, oh my God. And you can't make it an unlimited length. A loan that goes on for 1,000 years isn't really a loan, is it? Is it? And so the length of the loan can't be more than either 7 years, or in a situation where you've actually placed a mortgage over property, which is at least 10% more. So the property has to be worth 10% more than the loan itself. You can have a loan of up to 25 years. All right, you have to satisfy all of those things and satisfy the minimum annual payment rule, which is on the next slide. You have to do all 4 of those things when you're loaning money from your company to a shareholder, which could be you, in order to make this a criteria-based loan. There's a little formula here, which is the amount of minimum repayments you have to have. And it's this thing here. So the amount of the loan in total, the amount of the loan at the end of the previous year, so after repayments have been made. B is that benchmark interest rate. Again, that was the approximately, said about 4.5 or 5%, 4 or 5%. It's 1 minus 1 over 1 plus, so you've got the base rate in there again. And here, I don't know if you guys have done any software stuff, but where you see the caret, that means to the power of. All right, and T is the number of years remaining. Whole numbers. Tax law, they try to simplify things. So you guys would be aware when you're doing finance that you always do things to the day. This is done annually. So for better or for worse, it just is. So the number of years remaining is rounded up to the nearest whole number. So if you have a half year, it's going to be rounded up. All right, that's going to be the minimum repayment amount. If the amount that you as a shareholder are paying back to the company is less than that, then it's going to be, the loan is going to be deemed to be a distribution of that time. And look, ultimately, at the particular point in time, the amount of the entire amount of the loan is going to satisfy that. So that just be mindful. The entire amount of the loan is still outstanding. Okay, some compliance things. Distribution statements. When you issue make distributions to shareholders, and if you're a public company, again, remember this is public company within the meaning of the taxation law, you have to have what's called a distribution statement. So that's, I've got it on the next slide, what it's got to contain, but that must be done at the time the distribution's made. Whereas private companies is one of the areas where private companies actually get a little bit less slack. They cut a little bit, they cut a little bit of slack here. They have to just do it. You still have to do these distribution statements, but they can be done after the end of the tax year. They just have to be before 31st of October, which for us ordinary individuals, that's the time we have to do our tax returns by. Companies don't, by the way. Their companies have an extra year. But in this situation, distribution statements still have to be issued after the end of the financial year in which they were made. Okay. Look, we'll talk about franking credit deficits. If you are issuing more franking credits than what you have, that's a franking credit deficit. You must issue a distribution statement at that time. There's no two ways. You can't do it later. What do these things have to say? Yeah, these things. You have to be able to identify the payer, date, amount, the amount of franking credit attached, all right, which means that mathematically you could always work this out. But that said, it doesn't technically ask you to put in this what the relevant tax rate is for the company. And ultimately, you have to be a little bit mindful because that can change. Remember, if you, for example, if one year you've got 40,000, the next year you've got 60,000 worth of aggregated turnover. So there's withholding tax that's got to be in there, that's paid to non-residents. And there may be a bunch of other statements that talk about imputation because these things have to be on an approved form. Tax office tells you what you have to do. Okay, that's compliance stuff. Franking. So when you gain franking credits, you have to account for that. And when you distribute franking credits, gain or lose franking credits, you have to account for that. And they are not included in your statement of financial position. You do need to explain them, and that's what that ASB, whatever it is, 1054 item 12 talks about. 1054 talks about these things, that they need to be disclosed, but you don't need to okay, start again. Where you're following the international reporting standards, because that's American driven, they don't have any system of franking credits. This is just not how their system works. However, if you are creating reports for Australian entities, then you do need to include this section which explains how the franking account's doing, regardless of that, even though it doesn't go on your statement of financial position or balance sheet. Also note that in Australia, we use the old word, which is franking credits. However, in New Zealand, I think they always have referred to them as imputation credits. And in regards to the relevant standard, they mention franking credits exactly once. They say, look, franking credits and all of this stuff are referred to as imputation credits, which is probably the more technical, correct name, but franking credits is a name that's stuck. It's a bit like stamp duty. Everyone calls it stamp duty, even though it's not technically what it's called these days. All right. And this is, I suppose it's a thing to know. If you, for whatever reason, distribute to your shareholders more franking credits than what you actually have, you will be liable for something called franking deficit tax. And it's a little bit of a misnomer because franking deficit tax isn't really a tax. It's just a mechanism in which they make you pay the amount of tax that you're going to pay in the future. Because usually if you have franking credits and you distribute those, attach them to distributions and distribute them to your shareholders, you only got those credits because your company's already paid tax, right? So if you're accidentally, or sometimes deliberately, making a distribution and attaching franking credits, but you're distributing more than what you actually had because you haven't paid that much tax. What they say is that, well, we're just going to make you pay the tax now. That's why it's not actually that problematic, franking deficit tax. They do penalise if you do too much, which is in a few slides down, but ultimately the ATO was kind of happy to some extent because you're going to pay the tax anyway. All right, so how do you gain franking credits? Well, you're probably aware, for those that, I don't know, had to work and do accounting sort of roles, that you don't, if your entity is large enough, you don't pay your income tax on one big go at the end of the year. You pay it in installments based on your previous year taxable income. And that is called a PAYG installment. A bit like us as individuals. I mean, could you imagine if we were paid the actual gross amount? Just imagine how Australian society would implode within one pay period. Sorry, not one pay period. No, wouldn't have paid. No, sorry. It'd be a great time up until the end of that tax year. So if they decided now, no more PAYG withholding, people just get paid what their contract says, everyone would just, I think I said in class, pass it up against a wall, would all be gone. When tax time comes, no one's got any money, everyone's going to jail. That's essentially how that would work, which is why we have PAYG withholding. It's an excellent idea. And curiously, I've had, oddly actually, I've had people coming from other jurisdictions coming to Australia, really worried about the money that's withheld. I'm like, no, don't, it's not being stolen. Don't worry about that. You'll get it back later on. They get really anxious about that. We don't, because we trust our tax office. Now, so if you pay PAYG installments, what that means is that when you're paying income tax, it's really only the terminal amount. Because if you, for example, say in the previous tax year you had, I don't know, 100 odd grand, so you paid 80 grand's worth of, if you had $240,000 worth of income, no, that's not going to work either. $320,000 worth of income, and you paid $80,000 worth of tax. So what they'll usually say is that, look, in the next tax year, you're going to need to pay $20,000 every 3 months, because that's what we reckon you're going to have to pay at the end of the year. So these are PAYG installments, and we talk about this in tax too. And when you reach the end of the year, let's just say you've made, I don't know, 400 grand, and so you're going to have to pay $100,000 worth of tax. So you've paid 3 installments of 20. The final one is just the remainder. It's 40,000, and so that terminal amount is the will be a franking credit as well, but it's only the terminal amount. So each of the PAYG installments count towards your franking credits. So that's, your franking credit changes whenever you make one of those installments. It also changes if you receive franked distribution, so money that comes from only Australian companies. Okay, because if you have shares in Telstra, Telstra gives you a $10,000 distribution. How much of that's going to be in cash? Go on. How much cash are you going to get on a fully franked distribution from Telstra of $10,000? Telstra, big entity, revenue more than $200 million, or whatever it is. What's its tax rate?
Oh, you
What's
confused me by saying cash, because like in my head it's like physical cash, and I was like, well, they would never deal with that.
I have to admit, that is a shortcut, and I apologize for that, because accounting, all of the accounting students, when we say cash, what do we actually mean? Sorry about that. I didn't even. That's fine. Yeah.
Yeah, anyone I don't know that's not an accounting student, cash to me is physical money.
Yeah. It's funny. Yeah, you're right. You did right. So I actually didn't think of it, because it's. I mean, I've studied accounting in high school, which I've spent almost 30 years. It's a bit like Stacey, how do you spell the word judgment, meaning a judgment from a court? 1 E or 2? No. Try again.
Are you serious? serious? That's right. I'm half dyslexic, but let me Google this.
Judgment from a court, spelt with only one E. When you and I use our personal
It is
judgment,
too. Oh my god!
yeah.
You know what?
I
I'm a
that's
bit
funny because
dyslexic.
I tell everybody, oh, everyone learns that in their first week of law school. Anyway, your first week of accounting school, you learn that when we talk about cash, we almost always mean cash in a bank account. That's what we mean by cash. Things that could be, I mean, yes, we could readily convert it to banknotes, but that's kind of a trivial or pointless thing. That's what we mean. So when I'm talking about cash, I mean that they've debited the money directly to your bank account. So going back to Telstra, if Telstra gives you a $10,000 distribution, so you're going to add $10,000 to your taxable income because you've just been given, how much of that will be in the form of cash if it's fully franked? Remember the size? Does Telstra have an aggregated turnover of more than $50 million? Yeah, got it. That's right. Good. So if you get a distribution, yep, got it. Got there in the end. Yeah, good. That's it. Literally, that's absolutely. If you don't remember anything else from this whole class, those numbers is all you got to know. Because this is going to be sort of bread and butter stuff day and day. If you're doing financial planning, tax advising, and even in your own life, when you're receiving distributions from things, these are just the numbers. They just are. And so you'll do this a few times, and then as I said, when eventually I get around to building the quizzes and stuff, you'll be, yeah. I think, sadly, if anybody is watching this recording at a later stage, I think what I'm going to do is put in more calculations for the company test, even if they're simpler ones, because this stuff it really is. It's bread and butter. Duff, duff, duff. I just be able to know those sorts of numbers. So the key thing to note, look, if say Stacey's little closely held company, Stacey Corp, Proprietary Limited, in that situation, if Stacey's tiny little company gets a $10,000 distribution from Telstra, $7,000 is going bloop into a company bank account, great. $3,000 is a franking credit, and it goes to her company's franking credit account. So her franking account is credited. That's the good one when we're talking on that side of the equation, remember? Oh, again, this is a little bit tricky. Stacey, forgive us. A? Oh, it's T. Sorry, start again. Sorry, I'll do it as a proper T. So you've got assets on this side, you've got liabilities.
Are you about to do math? Is that why?
No, we're about to do accounting. We've got owner's equity down here. The idea is that this side is the debit, which is DR. This side is the credit, which is CR. If you're increasing these items on the right-hand side, you credit it. If you're increasing items on the left-hand side, you debit it. And so if you credit an asset or you debit something on the right-hand side, either liabilities or owner's equity, you make them smaller. Okay, so what does that mean? It means because franking credit accounts kind of sit in here, kind of. If assets increase when you debit them, liabilities increase when you credit them. Yeah, good. Yeah, good. Thanks, Frisbee. Exactly. So if we assume that franking credits are held kind of in owner's equity, when you credit them, you increase them in value. So if you pay PAYG, you pay income tax, and you get franking credits from a frank distribution from an Australian company, you increase the value of your franking credit account. That's the amount of credits you can then distribute to your shareholders. It also occurs if the company is a beneficiary of a trust or a partner in a partnership, in a corner case. But the other one that'll come up here is when you incur liability to pay franking deficit tax. So if you either deliberately or hopefully accidentally actually distribute more credits than what you have in the account, you become liable to pay franking deficit tax at that time. when you become liable, you have to pay that tax at the end of the year. But your account actually goes up. They literally say, okay, all right, sure. We're just going to magically make these franking credits appear, and just makes the entity liable for that franking deficit tax. How do you lose them? When you give them away. When you make a franked distribution, give them away. Also, for whatever reason, you get a refund. So if you get money back from the tax office in regards to overpaid amounts. So if you make a PAYG installments, going back to that example of me paying whatever it was, I was assessed to pay PAYG installments, and I've paid 60 grand. When it comes to the end of the year, if I've only made a taxable income of like $200,000, I'm only assessed to pay $50,000 tax, but I've already paid PAYG of 60. So they're going to give me $10,000 refund. That amount will be debited to reduce my franking credit account as well. If you underfrank, that's a bad thing. You don't want to do that. It's on a slide, 2 or 3 slides down. Get back to that. If you stop being a franking entity, sure. I'm not sure how that happens. And a couple of other obscure ones on market share buybacks and so on. Also dividend streaming. That's our very final slide, which we'll talk about there. That is a situation where you will lose franking credits from your account. All right, bit of compliance. Franking period, that's just the we need to know the franking period because that is the point in time in which the benchmarking rules come into effect. So for private companies, they have only one franking period. That's actually a disadvantage rather than an advantage, as you'll see on the next slide. Public companies have 2, and usually they're 6 monthly. So they will reset on those days, or actually technically reset and start again on the next day. All right, what do I mean by these franking periods? Well, there is a rule. It took me a while to get my head around this, and even now I'm still a little bit as to why and how this works, but I can give some examples. So what the ATO, or what the Federal Parliament, when putting these laws in place, is trying to do is to stop people from being able to manipulate distributions and franking credits to give franking credits to those who can use them and not give them to persons who can't use them. So this benchmarking system is an anti-avoidance mechanism, which, for whatever reason, the Parliament and the ATO think is a way to stop dividend streaming from happening. So it goes like this. When you make your first distribution of, first distribution, basically dividends that you pay to your shareholders in a franking period, again, for private companies, that's the first one you make in the financial year. For public companies, it's every 6 months. If you make a distribution with a certain franking percentage, you will be penalized if you change the franking percentage on subsequent distributions in the same franking period. Okay, that franking percentage, or that first one that you make, is called the benchmark franking percentage. I don't know how successful this is as an anti-avoidance mechanism, but it's the law, and you need to know these rules. So I think the idea behind it is that if you could manipulate your franking percentage, you could have, for example, some shareholders who can't benefit from franking credits receiving, on selling their shares or doing some sort of swap with people who can benefit from them, then having a a frank distribution, and then swapping back a few days later having an unfranked distribution. So that, I think that was the idea that they'd had here. Nonetheless, you must note the franking percentage. So if they go back to those Telstra shares, so what was it, $10,000, Stacey's company got that. If Telstra decides that they want to do a second distribution in that same 6-month period, they better frank it the same amount, which will be 100% in that case. Because if they don't, they're going to suffer these penalties. And what are these penalties, you say? Well, if you underfrank, so let's just say you, Telstra has had this $10,000 right distribution to Stacey's company. So $10,000 of income, remember this is income, is going to SRPL, Stacey Rogers Proprietary Limited. All right, if it's gone to SRPL in the form of, what did I say, $7,000 cash plus franking credit of $3,000, that's fine and good. Okay, let's just say that that happened on the, I don't know, 1st of August. So this is from Telstra. If, going forward a few months, to the, they have 2 periods. So we'll say on the 1st of December, if Telstra decide that they want to do another $10,000 distribution, but this time, they're only going to half frank it. So this was 100% franked. This next one is going to be 50% franked. How much franking credit is going to be attached? And how much cash is there going to be? So the maximum that we were allowed to put in when we had 100% distribution was $3,500. What's the amount we're going to put in now? Okay. Everybody's excited about this. I admit it's pretty hard stuff, so I'm not going to give you too much. But basically, you are going to have, if it's a 50% distribution, it would be $8,500 cash plus $1,500 franking credit. Okay, that's a 50% frank distribution from Telstra. Are you guys with me so far? Please, 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 people are with me.
I'm here in attendance physically.
Sorry. Love you. Okay, so the idea is with these, and again, I knew the language was going to throw some people off because the franking percentage is basically it's the fraction of the whole distribution that you've fully franked. To frank a distribution, fully franked distribution, is to attach the maximum amount of tax credits as a part of that whole distribution. So when something comes from Telstra, because it's a big company, it's got a 30% tax rate, the most tax credits they can attach to a distribution is 30%. If they elect, for whatever reason, to only half frank the distribution, then the amount they're going to attach is just going to be 15% in that case. It's half the amount. That's franking percentage of 50. Now, however, because they've changed, if they did this, they almost certainly wouldn't do this for this exact reason. Because they're still in the same franking period, big companies have 6-month franking periods from the 1st of July to the 31st of December. Because they're still in the same, danger, bad, bad, bad. Why? Because the amount that's going to be debited to their franking account is going to be what the amount ought to have been if the benchmark percentage was followed. What's the benchmark percentage? There we go. What's the benchmark percentage in regards to this? There's numbers all over the show. Benchmark percentage is this. Oh, benchmark frank. It's the franking percentage applied to the first distribution. In this case, That's 100%. It's up here. So the amount that's going to be debited and taken out of the franking credit account is going to be the amount as if it was set at 100%. So it's going to be this amount. So this amount's coming out, even though you've only given to shareholders this amount. So functionally, Telstra has just wasted whatever it is, $1,500. In regards to you, obviously, if you're doing that multiplying by all of your shareholders, they've just thrown away and voided a whole bunch of tax credits. That is the penalty for underfranking. That's if you go under the amount that you first did in a particular period. Look, people don't do this. It's a punitive mechanism to stop people from doing it. All right, so shareholders do not get any benefit from this. Similarly, if you increase the amount, okay, so here, going back to this similar example, but the other way around, if on the 1st of August, you had instead, Telstra had paid the distribution of 8.5 cash plus 1.5 credit. All right, what's the franking percentage on that? Everyone's deathly silent. That's a franking percentage of 50. It's half the maximum amount. Yeah, good. Thanks, Matty. Cheers. If then later on you did the opposite and then paid 7,500 plus 3,000, we would then change that on the 1st of December. We're still in the same franking period, therefore that would be a franking percentage of 100. Naughty. So if it franks its second and subsequent distributions more than the benchmark, the difference between the amount of credits distributed and what the amount ought to be if the benchmark percentage was followed is credited to the company's franking credit account as a franking deficit tax. So in other words, this amount here, so start again. This amount up here in yellow, what they're basically doing is saying that, look, in this situation, we're going to make that the same as that. We're going to deem you to have essentially created a whole bunch of franking credits by debiting this amount the difference between those two things, the difference between that one and that one, we're going to retrospectively credit this to your account, all right, and make you pay franking deficit tax after the end of the year. All right, so they pay that as an additional tax. Now, down here I've got franking deficit tax. It's payable 1 month after the end of the current income tax year. All right, that's way sooner than income tax. Way sooner. Income tax. Remember, you got a whole year to do your your tax return, so you don't have to pay tax for ages afterwards. That's really where that's at. Probably should put this as a separate slide. There should be a separate slide. FDT. DT. So that's what franking deficit tax is about. Additionally, if you overfrank a distribution, so you've paid more money, and so you've got an amount of franking deficit tax. If that's more than 10% of all of the franking credits that arose during the year, you're going to have to pay a penalty. And the way that they do the penalty changing the amount of offset that you get for the FTT which is paid. So if, for example, you've going back to this previous one here, they have to pay, in regards to Stacey's distribution, $1,500 worth of franking deficit tax. Okay, and once they do pay it, so you pay that a month after the end of the financial year, so they'd have to pay this amount, but they're going to get an offset to be applied at a later stage. Because, I mean, ultimately, they're just prepaying tax, really. That's what franking deficit tax is doing. You just, usually, you pay tax, then you distribute the credits. And so what you've done here is you've distributed the credits, and then later on you're going to pay the tax. And the two will balance each other out. That's fine. It'll eventually reach zero. However, the way they do it is through an offset. And if you actually have 10% more than all of the credits that arose during the year, so that's not the aggregate amount, that's just the sum of all of the credits. If, for example, Telstra, if Stacey was the only shareholder, and Telstra had less than $15,000 worth of tax credits in that year, this would, so it would have to be less than that amount, then this $1,500 is going to be reduced by their tax rate. So you have to multiply it by 0.3 in that case. So 3, so it would be, so the offset in this situation would be, I don't know, 10,500. Did I do that right? Yeah. So that would be the tax offset that they'd have for the next year. This bit, you're going to have to look at again afterwards if the previous stuff was clear as mud. Oh no. Oh no. I suggest you go through and just have just go over this one again when you get the chance. Because I think at this stage, like, what are we at 10 to 9? We've still got a shoot to do too. Yay. Just it doesn't apply. There's no penalty to private companies if they deliberately or accidentally successfully over frank. We're not going to penalise them for that. Okay, and finally, dividend streaming. If there is a situation where the ATO reckons that you are giving preference somehow through distributions to shareholders that can benefit more from franking credits than others. And that can be, for example, if you have classes of shares. If you have A shares, B shares, and C shares, these are arbitrary names. When you fill in to register your company, you get to choose arbitrary names for your classes of shares. But if you pay all these as franked and all these as unfranked, because these are held by two different classes of persons, then an amount, and again, this is up to the tax office, can be debited as part of that. They'll just do that arbitrarily as a penalty. Okay, and that's known as dividend streaming. That's when you're giving different amounts of franking percentages. So say that's 100% franked, and that one is 0% franked, and that one can be whatever, 50, 100 as well. If these guys here, B, for example, couldn't make use of franking credits, but A could make use of franking credits, that is dividend streaming as far as the tax office is concerned. And so that as a result, they can just simply debit an amount after an investigation.